There are a lot of such common mistakes, and I will just draw a few examples here. The first very common mistake is return chasing. Investors tend to look at the near-term past return when they decide which fund or stock to buy. However, little evidence suggests that this kind of strategy works. For example, a Vanguard research suggests that by pursuing a strategy of buying the best performing funds based on their past 3-year track record will cost investors about 3 to 5% every year during a 10-year period versus a very simple strategy of buy and hold. And this is across the board in large cap, mid cap, value, or growth funds. And this kind of mistake is observed in big funds as well. For example, Fidelity Magellan is one of the biggest funds in the world, used to run by a legendary fund manager called Peter Lynch. Mr. Lynch delivered outstanding performance when he was managing the fund by beating S&P for about 26% during the first 6 years and 4% during the next 5 years. However, most investors only bought into the fund after 1990 when Mr. Lynch retired, and what they got was a S&P-like return, which was probably very different from what they had in their mind when they decided to buy the fund. Another such example is Legg Mason's Value Trust Fund, used to run by another legendary fund manager called Bill Miller. Mr. Miller has consistently beaten S&P by about 5% every year for a period of 15 years, which was truly outstanding. However, again, most investors only bought into the fund after 2005, and what they got until 2011, when Mr. Miller retired, was an underperformance of about 7% under S&P. Another common mistake that investors tend to make is to ignore the importance of diversification. A good example here is Enron. When Enron declared bankruptcy in December 2001, 62% of its company 401k retirement pension account is holding its own stock, which dropped from $80 to 70 cents in a matter of 12 months. And this is a very serious mistake of them to tie their financial fate to just one company stock.